Hello everyone, welcome back to my YouTube channel Sachin Education Hub. Friends, today we will here to discuss about differentiation between security market line and a capital market line. And these both lines are actually depicting the risk and return relationship between different types of securities. And this is a very important question in the portfolio management subject for the purpose of examination. So clearly understand this question in this video till the end of that video. Okay, so before starting that video, if any one of the you required any commerce subject related notes, then he or she can go to our Telegram channel as well as go to our website, and the link for both of them is available in the video description box. Okay, so firstly, the differentiation is on the basis of definition. So what is a security market line? First of all, actually, if I talking about a security market line, this is a graphical representation of a capital asset pricing model, which depict the risk and return relationship for the individual security. It is a actually graphical representation of CAPM model, which depicted you what, as you see in the PDF, risk and return relationship for the individual securities. And what is the risk in this case? Risk is known as systematic risk. But if we talk about CML, that is capital market line, then capital market line is also showing you the relationship, but not relationship only. It is a trade-off between risk and return. It is showing you the trade-off between risk and return for the portfolios, of the diversified assets, So CML shows you the trade-off between risk and return of the different portfolios of the diversified assets. But if we talk about the individual security risk and return relationship, then it is shown by the SML, that is security market line. Okay, so this is the main differentiation. After that, the differentiation is on the basis of focus. That is security market line focus primarily on the assessing risk and return relationship or the characteristics of the individual securities only by isolating other securities. But CML, that is capital market line, focus on risk and return trade-off for the diversified portfolios by recognizing that the combination of the assets can affect the overall risk and the return of the portfolio. I repeat my point again. Carefully understand these points. First of all, SML means it only focus on individual security risk and return relationship by isolating the impact of other securities. But if we talk about the CML, that is capital market line, then it shows you the trade-off between risk and return of the diversified portfolio by recognizing combination of assets that can affect the overall risk and return of the portfolio. So this is the main target of both the lines, right? After that, the differentiation is slope, on the basis of sloping. So the slope of SML, that is security market line, is determined by the market risk premium. That means differentiation between expected rate of the market portfolio, expected return of the market portfolio, and the risk free rate. As you see in the PDF, there is a formula that is RM minus RF, which means the difference between expected return of the market portfolio and the risk free rate. But on the other side, if we talk about capital market line, then it is determined by the Sharpe ratio. Sir, what is Sharpe ratio? Actually, Sharpe ratio is that ratio which help the investors to measure the excess return per unit of the total risk of a portfolio. I repeat my point again. Sharpe ratio is actually the ratio which help in measuring the excess return per unit of the total risk of the portfolio. So the line that slope is determined with the help of Sharpe ratio, that is a line known as CML, that is capital market line. But the line that slope is determined by the market risk premium, then it is a security market line. Hope you all understand that. Okay. After that, the difference is based on the interception. What is interception? the security market line intercept means intercept means intersect. So SML, that is security market line, intersect with the y-axis, that is at the risk-free rate, but capital market line intersect with y-axis, that is above the risk-free rate. Security market line is at the risk-free rate, but on the other side capital market line is above the risk-free rate. And risk-free rate is the return expected from the risk-free investment. Risk-free rate is a return that is expected from the risk-free investment. Okay, so this is another difference. Thereafter, the differentiation is on the basis of purpose. So security market line is used to determine the price of individual security. In short, it help the investor to determine whether the security price is undervalued, overvalued, or whether the security is fairly priced or not. But on the other side, capital market line is used to assess the trade-off between risk and return of the diversified portfolio. And thereafter, it help the investors in guiding regarding the balance between risk and return of the different portfolio very efficiently. Okay, so this is the differentiation on the basis of purpose. After that, what are the applications of both of them? So security market line is applied in CAPM, that is capital asset pricing model, to price individual securities based on the systematic risk and return. But on the other side, capital market line is applied in portfolio management to construct the efficient portfolio with risk return trade-off. So in short, you can say that SML is used in CAPM and CML, that is capital market line, is useful for the portfolio management, right? Now the difference is based on the risk-free asset. Actually, the risk-free assets serve as the starting point for the security market line, which means representing the minimum return the investors should expect for taking on no risk. But on the other side, capital market line, in the capital market line, the risk-free asset serve as both starting as well as ending point. Because in this case, investors choose to invest solely in the risk-free asset, or sometimes they also want to combine it with the risky asset to make the diversified portfolio. There is a choice. Because of the risk-free asset, there is a choice for the investors. Because in CML, that is capital market line, they can choose anything. They can choose anything from two options. They can also invest solely in the risk-free asset, or they can also combine it with the risky asset to make the diversified portfolio. So you can say that this is the reason in the capital market line, risk-free assets serve as both starting point as well as ending point. Okay, thereafter the next point is on next difference is on the basis of market efficiency. In the security market line, you can say that security market line reflect the market efficiency in the pricing of individual security, but the capital market line reflecting the market efficiency in pricing the portfolios. So if we talk about the pricing of individual security and the market efficiency in these pricing, then it is only with the security market line, because security market line is only and only dealing with individual security in the isolation from the other security. But on the other side, if we talk about the portfolios, diversified portfolios, then in this case, capital market line serve as a reflection for the market efficiency in this case. Okay, so this is another difference. And the last but not least difference in these two terms is utility in practices. Actually, what is the utility of these two lines? Where these lines are very useful? So SML, that is security market line, is very useful by the investors and analysts to evaluate individual security and to make the investment decisions, particularly in the CAPM model. as well as portfolio management. But on the other side, capital market line is used by, specially used by the portfolio managers and investors to construct the diversified portfolios that balance the risk and return efficiently. And it also helps the investors in guiding about the asset allocation decisions and the portfolio optimization strategy. So in this way, you can say that both security market line and capital market line are useful for the investors, but especially security market line is used by portfolio analyst, but on the other side capital market line is mostly used by the portfolio manager, not the analyst. Okay, so these are some differences between two lines. So that's all. So these are all the important differences that make the capital market line differ from the security market line. Okay, hope you all understand these points very carefully. If yes, then please hit the like button and share that video as much as you can. And also, if you are new in the channel, then please hit the subscribe button also and press the bell icon for the regular updates. Okay, so thanks for watching. Goodbye. Tata.